Hi, this is Pat Moorhead with Moor Insights Strategy, and we are here for another 6-5 podcast, and I am here with my amazing co-host, jet-setting back and forth to Spain, Daniel Newman. How are you, my friend?
I'm doing good. Long week last week, New York, transcontinental, back here this week, Pat, and then you and I are doing some jet-setting, Las Vegas, Kona, which everybody seems to be super jealous about until you remind them that we're leaving and red-eyeing in on Tuesday morning and then red-eyeing back on Thursday evening, and you're like, it's not that awesome, but I'm looking good. I'm not feeling too jet lagged, a little tired, but all is well.
No, it's good. Yeah, it was a great weekend. We got a great show, but for those of you who are joining us for the first time, we cover 6 topics, around 5 minutes each. Not a lot of news, just enough for context, but we really like to get into the meaning of it. And we will be talking about publicly traded companies, so don't take anything we say as investment advice because, this is for educational and hopefully entertainment purposes only. So Daniel, let's jump right in. We've got IBM, we've got SAP, we've got Qualcomm, we've got Lattice, we've got NVIDIA, and we have Cisco. So let's dive into topic number 1. As you know, there is a huge battle going on in quantum. It's early, right? Some people say it's going to, it's going to hit impact in 5 years. Some people say 10, some people say 20. All I know is there's a ton of investment going into this, and IBM is making some really big moves. They had a huge announcement at their Quantum Summit, which was pretty exciting. So I would say the highlight here is IBM rolled out a 127 qubit quantum computer, and it is the first quantum computer with more than 100 high quality qubits. And as you know, it's not just about the number of qubits, it's about the quality of it. By the way, we're doing a lot of research on this. Paul, our principal analyst of quantum and space, we're still getting underneath this. So I'm going to try not to make too many claims here, but 127 qubits does put it beyond reach of today's classical computers' ability to simulate that. And we did see that. I believe they were doing a fusion ion, or maybe it was a lithium ion simulation, where running it on quantum took 7 minutes, and I think running it on conventional took about 7 years. I thought that was pretty cool. The other thing that IBM did is they rolled out a new measurement, which added this idea of speed, okay? Scale, quality, and speed, which, by the way, at the outset, looks very rational. I get that, particularly the new speed, but I really wish they hadn't rolled this out within 18 months of rolling out quantum volume, right? Because if you remember, first it was all about qubits, and then it was all about quantum volume. And now, at least according to IBM, and it's hard to disagree with them, is adding this idea of speed, and that's gate speed. So pretty good stuff. We're doing a lot more research on this to see if we can take bigger shots at it. But I think the big picture is IBM is moving up and to the right, increasing capabilities. IBM happens to have one of the bigger development communities out there, and they have more logos associated with their quantum name than any other company right now.
Yeah, it was a impressive announcement. The company is basically on a trajectory of announcing a new processor almost on an annual basis. They had the Falcon in 2019. They had the Hummingbird in 2020, and now this is the Eagle processor. Of course, for those of you that kind of follow the basics of quantum, IBM builds on a superconducting platform as opposed to a lot of what we talk about ion trapping. Often when we talk about, say, Honeywell or say IonQ, we talk about ion trapping, which seem to be the two most popular methods right now for building out quantum. This increased number really is all about being able to drive and accelerate applications that we are familiar with but haven't become overly familiar with in a quantum formats such as machine learning, modeling molecules for drug compounds and drug compound creation. So we're seeing that happen very quickly. I thought overall, Pat, that this was an important announcement that because of the academic and importance of research and that showing that the company is continuing to move forward when you are hearing so many announcements from the entire field of quantum about advancements. I also do like, hearing more about the practical relationship that's going to take place between quantum and classical. Right. While you did mention specifically that this is an example where quantum will outperform, we've all come to a relatively strong consensus that the optimized outputs will come when classical and quantum computing are working harmoniously, so that quantum is working on solving the problems it's most well designed to solve, and concurrently, on the other side, the classical computing continues to do what it's most well designed to do. So this was a pretty strong announcement. And Pat, by the way, you and I will be doing a series of 6.5 videos with the IBM team around the Quantum Summit to dive deeper into IBM's advancements, customer examples, and then a little bit further into research in the academic side, which I think are the three major components that are being worked on from IBM. An important set of announcements as we continue forward over the next decade of quantum advancement.
Yeah, I'm super looking forward to that. And I believe that they'll also have some customers on there, which I'm looking super forward to. Super forward, not just looking forward to, super forward, baby. It is Monday and we are alive. I'm on my third coffee and probably my fifth shot of caffeine. So it is super excited. So, hey, let's jump to the next topic. SAP had its developer conference, lovingly referred to as TechEd. Danny, you want to kick this one off?
Yeah, absolutely. So back again, SAP TechEd, still virtual. We weren't able to be there, but hopefully very soon. And this year's event was, focused on a lot of things. It's a big conference. But for SAP, I thought this was an event that really was diving into closing skills gaps and making it easier to do business with SAP. So the company had a series of new tools and integrations announced. It had a series of no-code, low-code, and pro-code solutions for SAP AppGiver and SAP Business Technology Platform. It had composable enterprise solutions that it talked about across the ERP suite, SAP Integration Suite, SAP on a Cloud, SAP IBM for supply chain was a few examples. It announced some embedded AI capabilities for various functions designed to simplify processes across the organization. And then, of course, the company continues to use this event as a platform to talk about learning and educational courses to help students all the way up to professionals in the workplace to better understand SAP. Because, of course, if you're not familiar, and I'm betting many of you that watch our show are, SAP, it's an ecosystem. And understanding how to use it is a strong proposition for creating value and economic value and, of course, job opportunities for people. There was a lot of things that happened at this event, Pat, but I think when you have a broad event like this, what I always like to do is kind of say, what are a couple of the things that really drove my attention? And so a few weeks ago, when SAP had their most recent earnings, we talked a little bit about SAP and Rise with SAP, which is their new program that's all about making it easier to do business and easier to move your SAP instances to the cloud. If you followed SAP for a while, that's what most of the criticism of the company has come around, is whether or not the company is moving quickly enough to the cloud and our companies adopting the platform. We know that in order to move from SAP's prem to cloud solutions, really the process is a full-on lift and shift. So it's not as easy as some companies, and this has also kind of opened SAP up to some risk for companies to use this as a moment to maybe move on to other platforms. With Rise, they're building a whole set of solutions to make it easier for companies to move over to cloud. Now, this isn't what TechEd was all about, but some of the things that they announced at TechEd, specifically the Business Technology Platform, along with their acquisition of AppGiver, which are all about the company's next generation of no code and low code to make it easier for companies to be able to do business. And that was sort of an underpinning of my analysis of the event, was that the announcements that the company made were heavily leaning towards saying SAP wants to be easier to work with, whether that's through partnerships, whether that's through simplification in low code and no code, whether that's through simplified billing and streamlined workflows. But they understand the importance and the fact that a lot of risk profile that's been created through being a little bit of a more challenging lift to the cloud, and also for developing applications. So this event to me was heavy on the business technology platform, heavy on AppGiver. I think it's Giver, Pat, but I actually haven't heard it out loud or heard it a few different ways. So I want to make sure I'm saying that right. But that the SAP TechEd event was really about streamlining processes, making the citizen developer be able to help build SAP's value within the enterprise, and making it easier to do business with SAP for companies that have invested in the platform.
Yeah, I think you nailed it. And listen, I've been super skeptical of SAP over the years. I think I might have been tainted a little bit by using it back at AMD back in 2001 or something like that. So not the fairest comparison, but I'm slowly warming up to what the company is doing, particularly around the cloud. It's a company that knew what it wasn't going to be great at, and that was to stand up its own IaaS, very similar to a Salesforce or a Slack or a Zoom, and focused on its core competency, which was, and I know it's more than an ERP company, but that's really where the rubber meets the road. What I liked about these announcements, and Daniel, I think you nailed it, was hitting on that simplicity. SAP has had a reputation for being hard to work with, and that's primarily because it was an on-prem play, a software play back in the early 2000s. And I remember even being where I worked at AMD, we always had to put a wrapper around everything SAP to make it easier for end users and developers. But the company has really transformed itself over the last 20 years. And I think particularly in the last year, as I become to warm up to the company, that are doing things dramatically different, whether that's RISE to help customers get into the cloud in a more simple way, whether it's acquiring SaaS companies like Ariba that I know you use, Daniel, and I use as a company, because of a lot of our clients are on that, and it's nice to get paid through that service. But now for this, it's low code and no code. And quite frankly, if you have an ecosystem, if you're a company, you have to have low code and no code because of the drought of programmers. And we've heard this. This is not just an SAP thing. This is Microsoft. This is AWS with Honeycode. This is Power Platform. This is anybody with an ecosystem, even Salesforce. So I like what I'm seeing from SAP. And Daniel, I'm warming up to the company as we move forward here. So
if I could do a quick boomerang, because we're going pretty quick, but the one thing I do want to say is we are not by any means saying that this is like a sudden correction. There's certainly I like that you mentioned the friction, Pat. I like that you mentioned the reputation. But what I do see is a genuine effort. I've seen genuine growth in cloud, which means the company is not just accepting. Remember the Microsoft transition where they went from sort of talking about moving to cloud to under Satya, they really did it. And there was a little bit of a sidestep and almost a step back that had to happen. The other thing is I've listened to this company for years talk kind of about low code, no code, and simplifying processes. And it had felt a little bit empty. And now I think what we're seeing is a genuine effort and genuine advancement in the product and the technology to build a more robust, stable ecosystem to keep customers onboarded and to make that migration to cloud. So apologize for that, Pat. I know we don't love the boomerangs, but I just wanted to reiterate kind of that we're not sitting here saying it's perfect. We're just saying that the progress is becoming notable and visible.
Yeah, Daniel. No, listen, boomerangs aren't always bad. I mean, we're really having a conversation here, but I think it's fair to really put where we're coming from. And quite frankly, for the last decade, I hadn't had anything nice to say about SAP. But directionally, they seem to be focused on many of the right things, particularly that their users are looking for. And, I got to do a lot of more research on them. I don't know if they're making any money when any incremental money when their software is sitting in the public cloud. But that's a similar problem that many other companies have. So let's move on to the next topic. Qualcomm had its investor day, which Daniel, you were there. Unfortunately, I could not make it, but it looked like a phenomenal event. I just did watch the whole event over videos, and the way that I would like to summarize this, it is they really showcased their diversification beyond the smartphone modem, growth and resilience. Those were my headlines. And even though Daniel, you and I have been kind of chatting about Qualcomm's transformation beyond the modem for a long time, I don't think a lot of investors really got it. And so what Qualcomm did a few quarters ago is they broke the numbers out. So they showed what Qualcomm calls IoT, automotive, and their RF business. But what we saw was a double click into those businesses that I thought was super, super important. And I'll leave some of that oxygen for you. So I won't do the drill down in that. But what Qualcomm did show that was amazing, I like to call it Apple proof. Meaning what they showed is that over time, their reliance on Apple gets down to low single digits by the end of fiscal year 24. And my hope is that blows up all the memes that are out there that somehow they're completely tied to Apple. And whether it's automotive, whether it's RF, whether it's the 5 different subsegments inside of IoT, the company is doing that. And if you go back maybe 6 or 7 years, this was a major issue that investors had with the company, so much so that they didn't believe the company. They chose Broadcom over Qualcomm. Okay, if you remember that the vote was going in there at the last minute, Trump came in and essentially saved the company. But investors were literally going to sell this company to Broadcom because it didn't necessarily trust. And Qualcomm is finally getting its day in the market. Their stock is soaring. Saw some really great growth, and it's good to see. There's a lot of execution though between now and then, Daniel, that they're going to have to do. Qualcomm is writing some pretty large checks, and I mean that in the figurative way. $13 billion auto backlog, up from another 10, and some other giant numbers in RF and IoT.
Yeah, Pat, you mentioned a lot of good things, and I think my most popular tweet from the Investor Day was the one where I shared exactly what you zeroed in on, which is the Apple proof. The market had been extraordinarily punitive towards Qualcomm when the Apple stuff came down, and as Apple has launched its 5G, there's been sort of an expectation that Apple would eventually completely migrate off of Qualcomm's technology, and that would somehow be devastating to Qualcomm. And I think being able to come out and basically say, yeah, it's a number, but it's not that big, is something that investors are going to take note of. And by the way, the market absolutely roared behind Qualcomm during Investor Day. So this company is a company that's had a couple weeks of absolute terror in a good way between its earnings, which were blowout results, and then now Investor Day, where the company put some additional context behind these numbers. The other sub-story, Pat, that you sort of acknowledged slightly when you mentioned the automotive backlog hitting $13 billion. There was an announcement this week of BMW making a significant commitment to the Qualcomm Snapdragon Ride and basically their whole platform, which is the telematics, infotainment, and of course ADAS that's going to be supported by the finalization of the Arriver acquisition. That was a huge win, BMW Group, for Qualcomm's whole end-to-end integrated automotive stack, but it's really been about their adjacent businesses as a whole. Everyone sort of has looked at this as a handset company and an IP company, a company that sells its innovation to everyone else to use, and a company that makes chips for handsets. The chips for handsets part has been sort of what's valued the company, and that's why that Apple thing has always been such a big deal. But what a lot of people beyond that and the licensing haven't realized is this company has now created I'll call it two plus businesses that are generating billions of dollars per year that have nothing to do with their handset and licensing under QCT. You mentioned automotive, which, by the way, is just going to miss $1 billion in actual revenue, but with a $13 billion pipeline. That's why I called it 2+. But then you've got IoT, which is now over a $5 billion annual business for the company. It's grown 67% this year. And then you've got the RF front-end business, which is an extremely difficult business to do and to replicate. They've instantly on the mobile end come in overtaken Broadcom, which you mentioned, Pat, growing 76%. From $2.4 billion in fiscal year 20 to $4.2 billion in fiscal year 21 with some triple-digit growth quarters. And Pat, I just want to say this because we like to ring our bell when we occasionally get it. Yeah. But just 7 days before, when Qualcomm's valuation was about 160 billion market cap, I wrote an article on MarketWatch and I said this company will be one of the next companies to hit 200 billion and hit mega cap status. Well, I believe, Pat, that it was like 7 days after I wrote the article, the stock went up like $30 a share. And it actually did hit about 203 billion last week on Wednesday when we were at Investor Day. So sometimes, Pat, we get it right. Sometimes we get lucky. But this case, I would think we were a little bit of both. But yeah, what a great week for Qualcomm. The company has to feel great. But to your point, big checks being written. And now that they've gotten kind of that Zoom boom of valuation, it's going to be up to them to back it up because people are not going to be satisfied if the growth falters or slows in any way.
Yeah, that's exactly right. And if I can do a loop back on the automotive, they did fantastic on there. I had a lot of questions on, hey, does this mean Intel's getting kicked out? The answer is no. Qualcomm won year 25 and maybe beyond that, but Intel is very much still a partner at BMW. And those are always the things that the questions I always ask is, okay, you got to win which model year? Is it exclusive for that year? How many years and what driving level? But regardless of any answer on that, by the way, it is 25 model year. It's a big win for them. And adding that to the GM win just makes it even bigger. And quite frankly, from a monetary point of view, I think the GM win is going to be bigger than BMW just because the volumes are so much higher there. But congratulations to the company. Let's dive into another chip play, Lattice. And Lattice acquired Mirametrix. So let me give a little background on this first. So first of all, there's a continuum of computing chips, right? You can have CPU, you can have GPU, you can have FPGA, and you can have an ASIC. And at one end, degree of difficulty to program is ASIC, and on the other end, the easiest to program, which is a CPU. But the challenge is you also have a sliding scale of battery life and how much energy. ASIC is the most energy efficient. CPU is the least energy efficient. And Lattice, in order to improve their time to market and really shrink that time for developers, is they've created stacks like Sense AI. So you add Sense AI plus one of Lattice's FPGAs, and you can essentially put that into vision systems, you can put into audio systems, you can put that into robots and not have to do that typical heavy lifting. And you can shave years off programmability compared to a fixed function ASIC. And this Lattice's acquisition of Mirametrix is another step in that direction. And essentially, so first of all, Mirametrix is a software company that leverages AI, and right now they're really focused on presence. A good example of that is on many Lenovo computers, you have a Mirametrix solution that, by the way, is running on the CPU and takes a bunch of battery life to be able to wake the system when it comes in, offers the ability if somebody is shoulder surfing, that's not your face, but running that on an FPGA takes it from watts to milliwatts, okay? And that's a huge deal. The other thing the other benefit of running this is if you are a PC maker and you want to have Intel, AMD, Qualcomm, and maybe in the future, NVIDIA, Samsung, or MediaTek, you only need one software solution stack, with a buck or two FPGA to limit the amount of development that you actually have to do. And guess what? Another benefit of the FPGA, if you want to reprogram it and have that connected to your camera to do some other things, or maybe even add a larger FPGA and do some tricks with your camera, you can. And instead of having 3 to 4 different solutions that you have to develop and support and improve, you only have one. So hats off to Lattice. They keep moving the ball down the court and reducing the amount of programmability it takes to do cool stuff with AI.
Yeah, Pat, this was a solid acquisition. It fits the direction that Lattice is trying to go in terms of being able to offer some very intelligent features that, a lot of people don't realize. Lattice works very closely in company with many of the larger, more well-known semiconductors to offer very specific security and capability features. In this case, I thought you had a great example in your Forbes article, but just talking about, like, I think you mentioned here, shoulder surfing, talking about the fact that we really haven't fully found the value in how we can use attention, everything from like a collaboration application to where, we want to better understand what are people really looking at when they're watching a conference, when a web conference online, Pat. And we all know that people turn on their machines and walk away. And this can give the capability for these software programs to better understand attention and focus. The other thing, of course, is security and safety. We know that visual hacking is one of the biggest risk factors for many people. We all think that it's sophisticated people, breaking into level 5 government agencies using Raspberry Pis like we saw in Mr. Robot. But the reality is they tend to be taking things written on sticky notes that we keep on our laptop or things that they're able to see over our shoulders. And that's how information becomes disseminated, especially in crowded public areas. And as mobility returns, risk profile for data theft becomes a bigger issue. So being able to instantly see, hey, this person's looking away, even as short as, hey, I'm turning my shoulder to the right to talk to the person sitting next to me. That person sitting on your other side could be staring at your screen, but when your eyes go off the screen for more than 3 seconds, it might darken the screen. And it's a more capable and competent technology than some of those visors, 3M technologies and stuff that people have to install and often don't use effectively. So interesting acquisition, Pat. I don't know what the price was for it, but I feel like it's probably very synergistic for Lattice, and it's going to be something we'll hear more about in the near future.
Excellent. So let's roll into another chip play here. NVIDIA had their earnings, and my goodness, NVIDIA is just on a roll here.
Yeah, it's hard to believe that just quarter after quarter, you're just talking about record after record after record breaking result, Pat. On the top line, they beat a 50% growth. They well exceeded the growth that was expected by the street, 7.1 versus 6.8. On the earnings side, they came in just above another 60% growth. Pat, you had record results in multiple categories for the company, $3.2 billion in gaming. You had an extremely strong data center result as well, $2.9 billion. That was 55% in the data center, 42% for the gaming. We've seen data center quickly catch up to that gaming category, but both have been extraordinarily strong. If I had to give one, only because it's like all good with NVIDIA, probably the only thing that I saw that was a little bit, of a pause for me was just that automotive, like when we've seen so much momentum coming out of Qualcomm, we mentioned that, is that automotive, it's up 8% annual, down 11% sequentially. But seemingly it's stalled out. I mean, you're talking about these businesses that have gone like data center from $1 billion to almost $3 billion in like the matter of 4 or 5 quarters. And of course, you got the Mellanox acquisition in there, but NVIDIA, which was one of the original, announced its newest Hyperion 8 drive platform, 2024 autonomous vehicles into the space, but yet down, or growing very slowly. You're only talking about 135 million. Now, one of the big numbers of interest, or the big topics of interest that came out of earnings, was a huge focal point for the companies, this Omniverse product, platform that it's building to be able to support the metaverse. We talked a little bit about that with GTC, so I don't want to spend a lot of time on it, but trying to better understand how the company is going to be able to monetize this through, being able to charge for things like its avatar services, things like being able to, charge for its data replication and simulation services. And he did go into that pretty extensively in the company's Q&A, which is interesting. I did have a piece on Market Watch on this and how exactly the company is going to likely monetize. And so we'll put that in the show notes. But overall, Pat, there's really not a lot that investors or people that are following NVIDIA can criticize about this company. It's really just it's growth, and it's been explosive. And the company was $200 a share after it split at the end of its last quarter, and I believe it's trading close to $350 just over 1 quarter later. So, I mean, the terror that NVIDIA is on has been extraordinary. Credit to Jensen and his team, and they're right on the front of all of these key trends. So you got to feel kind of bullish for the long sentiment that despite headwinds, despite chip shortages, despite the fact that, it has had so much growth in such a short period of time, more growth in its near future, it's hard to imagine any other direction.
Yeah, I feel like the only, if you can call it a blemish, would be auto, and it just hasn't moved that much, like you said. Qualcomm came in and took a lot of that dashboard share. And let's just be honest, the whole self-driving thing hasn't taken off like anybody thought it was, because NVIDIA certainly has enough design wins to fill up an entire page, but it just seemingly doesn't appear as if it's turning into big time revenue. Something I noticed that I thought was really interesting in the CFO notes was that there was almost a boilerplate disclosure that said, hey, even though our CMP cards are focused on blockchain mining, GPU cards that aren't limited can do this mining as well. And that to me got me thinking, okay, is the gaming market truly moving at this pace? And you can see from what I showed in that fourth quarter of 20, it was a $1.5 billion business. In Q3 of 22, it's a $3.2 billion business. Is that all gaming, or is it a combination of crypto mining plus gaming? So I feel like investors have bought into AI and essentially believing that NVIDIA owns everything in the data center for a long time, buying into gaming and not believing that AMD is doing anything there. So writing a lot of checks. And I don't think it's coming from NVIDIA actually writing those checks. I just think it's massive investor expectations. And Daniel, you nailed this. I think you wrote a Market Watch article that talked about potentially a $1 trillion company here. So kudos to you.
Yeah, I wrote that about a year and a half, maybe about 15, 16 months ago. It was right before right upon the announcement of ARM, which is ironic, because I thought that ARM deal was going to be fairly critical. And despite the fact, Pat, that the ARM deal has somewhat stalled, recent additional probes that are going to come out of the UK were announced. You have, a number of other hurdles for it to overcome. And the timeline, I mean, can you imagine, Pat, if the NVIDIA deal to acquire ARM passes, I think the $1 trillion is a sure thing, because it accelerated from under $500 million or $500 billion to almost 800 during a time when this has all been uncertain. So yeah, it's a crazy set of circumstances, Pat. And congratulations, like I said, I mean, on these results. All we can ask is, how long can this continue? How long can a growth like this continue? But we've said the same thing for AMD for a while too. Like, we're like, it's got to slow down, and it just hasn't.
It's funny though; it's a different thing. I mean, AMD
Totally
has
different.
relatively small market share. NVIDIA has monster market share.
Yeah.
That gaming number is not share shift with AMD. It's taking advantage of market growth. In fact, AMD is gaining share in GPU, but they're probably 1% market share in the data center to NVIDIA's 99% share in the data center. And that's the biggest difference. And if I were to say on the gaming side, NVIDIA has a much higher share of what I call premium gaming cards. AMD has a higher mid-range and low end. It's going to get interesting when Intel gets into this game to see what happens to all this growth. Heck, it could even grow the market even further, because a company like Intel can, even if it only, offers 10% or 5% of what the market needs, that's going to be an extra 5 to 10% that the market couldn't hit because of all the supply chain challenges. So Daniel, let's move to another earnings. Cisco had their earnings, and let me, some of the highlights here. I think the biggest one, and this is very similar to what they did the prior quarter, product orders were up 33%. Product revenue was up 11%. Now, it's interesting, a company that wants to lean into services and subscriptions, kind of leading with product orders. But I think, you lead with what your biggest strength was here. Overall revenue was up 8%. GAAP EPS up 37. Non-GAAP was plus 8. ARR, a good, I would say, proxy for services and as a service, up 10%, 20 to up to 22 billion. Every regions grew. 13 out of 25 countries grew 25%. All product and service groups except hybrid work, which was kind of weird at first, but then it's like, okay, it was a hard comp to a year before. But in the end, what really weighed on the stock was a soft guide. The company stuck to their annual guidance, but their quarterly guidance was weak, and they got punished for that. Company talked about supply chain challenges. I'm hearing from multiple people about supply chain challenges. Nothing new, except that it's kind of new for Cisco. But if your product orders are up 33%, you're likely going to have these challenges. It reminds me very much of the crazy quarters in the PC market when it was up 40, 45%, and everybody was a stock out.
Yeah, it was a interesting quarter, Pat. I like how you sort of said, they led with the order and hardware revenue growth this quarter, but I guess sometimes companies have to look at what went well and lean into that when they're announcing earnings. And sometimes, the most long-term strategic things don't always pan out in every single quarter. You look at sort of, the revenue buckets, the highlights and stuff like that. You've got some of the areas of big growth, like the Internet for the Future growth was tremendous. You looked at the, which is all about this, the scale up, for service providers. That was great. You look at things like hybrid work, and it was down, it showed it down for 7%, I believe, is in a decline, which is sort of interesting with WebEx. But at the same time, you are looking at with a return to work and the mobility coming up, that had to slow, especially on an annualized basis, because a year ago, our mobility was much less and companies were making much bigger investments. And sometimes people can't see that. Another area that was sort of interesting was subscription revenue as an overall percentage of services. You saw in the quarter as overall, it was actually the product subscription revenue was up, but as an overall revenue, because the revenue was up, it actually went down a little bit. So we want to see, that's because the hardware and the order growth on infrastructure went up. And while the revenue for subscriptions grew, it didn't grow as fast as the rest of the business grew. So it actually now shows that it's down a little bit. And that's something that everybody is really zeroing in on is, can the company pivot to ARR? Can it pivot to subscription revenue? Can it move off of licensing to more subscription types of revenue? And so all these factors are sort of working in, they're sort of magnetic polar, in a way where they work against each other at times. So you actually have a good result in one area and it hurts another area. Pat, this was a classic case, though, where I believe the guidance was like 2 cents. It was actually in range where the top end of guidance for this quarter came in at something like 80 to 82, and the street was looking for 82. I believe that's what I have in front of me here. Yeah. And so they basically penalized the company as if it was going to, it had made some really soft guidance. It basically said, we're going to be right about there. And I think everybody just wants to see growth faster. I mean, for a company like Cisco, an 8% year-on-year growth is good. I mean, now we're seeing consecutive growth quarters. We're seeing, some success in the right areas. And I think the market just as a whole has to start mentally adjusting for the fact that we are going to return to a more normal mobility path. The last few weeks, as I've gotten out and been traveling to events again, this feels like pre-COVID to me. And I know that nobody really recognized that there's a possibility we'd ever go back to traveling and being at events, but we are seemingly going back. People are going back to offices. It took me 2 hours to get from Manhattan to JFK Airport on a Wednesday evening, which just goes to 15 miles. People are out, right. People are moving, events are happening, restaurants are full. And that means that some of the things that we're being invested in that were heavily related to COVID are going to slow down. And it means that we're going to start to see buying cycles change a little bit again. Companies have poured money into tech. And they might have to pour money into different parts of the tech stack now that were neglected somewhat during, like infrastructure and stuff that's going to go in the data center. So Cisco will be a bellwether for this. That's what the company is. With such a diverse portfolio, that's what we're going to see. But like I said, I feel largely like the company had a good result. And I'm sure that the punitive nature of Wall Street had less to do with the company's results and more to do with the just completely unreasonable expectations that most people seem to have now for investments and returns.
Yeah, good analysis, Daniel. The final thing I wanted to add, first time I've seen service provider up in a long time, and that's part of this Internet of the future. So when the hyperscalers became a big part of service provider and they started doing their own switches and routers and things like that, it looked like Cisco was just going to get completely pushed out of that market. And to their credit, what they did is they did co-designs with hyperscalers and tier 2 hyperscalers to help create this Silicon One and a set of routers and switches and things like that that are co-designed by the hyperscalers and the tier 2. So hats off. It looks like that's starting to pay off. Now, you got a good comp, of course, right? Because revenue wasn't rocking it, but it's really good. Really good to see a company's plan come together. So Daniel, guess what? We are at the end of this. Gosh, we've got a lot of travel coming up. Let me see. AWS reInvent coming up, then Qualcomm and Kona, and then off to CES after Christmas.
Absolutely, Pat. It's going to be a whirlwind. 2022 is starting to feel like 2019. I had hoped. I'll be clear. I'm very happy to see our world gaining some sanctity and normalcy, and that people are getting healthier, and that we are solving this global pandemic and the challenges that it created. But Pat, I did enjoy traveling a little bit less. Yeah. And so I am a little bit stressed about this, but at the same time, it's going to be so great to see so many people, many of you that watch our show. And I'm going to be looking forward to elbow bumps, knucks, shaking hands, hugs, whatever it is that we all decide is good enough and safe enough for the rest of us, Pat. But yeah, what a weekend. By the way, happy holidays. If Thanksgiving is part of your slate of celebrated holidays each year, just want to say happy Thanksgiving to y'all.
Yeah, and thanks for tuning in this morning. Usually we do this on a Friday, but we moved it to a Monday because of Daniel. Daniel travel. But it's great to be on the pod again and see you in a week or maybe two. Thanks for tuning in and have an amazing week.